If you start looking for beta in the venture asset class, which is basically what you're doing if you're investing into the Andreessen like large fund at that point, then where is the alpha coming from? Emerging fund managers outperform on the top decile versus established or upmarket fund managers. And if you're an emerging fund manager, you have to have a much more discrete and nuanced thesis. You're maximizing shots on goal, and you got to get one or two of those. We love talking about the industry, we love talking about the markets and the trends.
This season of The Inquisitive VC is proudly sponsored by Carta. Carta is transforming how private capital operates, connecting founders, investors, and LPs through purpose built software and services. Trusted by over 65,000 companies in over 160 countries, Carta supports everything from equity management to fund administration, powering nearly 185 billion in assets across over 9,000 funds and SPVs. Whether you're building a company or managing a fund, Carta is the modern infrastructure private markets have been waiting for. If you'd like to find out more, check out their website in the show notes. Hey, welcome, Bhavik. I'm excited to have you here.
Thanks for having me.
Thank you for joining. I wanted to start with a quick high level on your background and what you're currently doing at Carta.
Yeah, of course. My name is Bhavik Vashi, managing director at Carta, looking after Asia Pacific, Middle East, and Africa. So really, a large portion of our international business, which is a relatively new business for us. So Carta has been around since 2012, but our international business really started in 2021. As we saw a lot of success in the US and we found product market fit both for our cap table and kind of private company offering, but also our fund administration, fund accounting platform in the US. We kind of had this realization that there's this larger opportunity and private capital is really a global problem. And so it's been fun. It's been a really fun journey to be here at Carta for the last 3.5 years, building out our presence across these really unique, exciting, different markets in this part of the world. I spent most of my career in SaaS. So I started as an accountant. So that's kind of like the connection to what we do here. But for the last almost 15 years, I've been in B2B SaaS companies. And for the last 10 years, I've been here based in Singapore, building and scaling the Asia Pacific piece of global businesses.
Very cool. Um, so Carta supports over 9,000 fund managers. What unique perspective and insight does that give you in your business of the current state of venture capital?
Yeah, it's I think one of the things I love about most about working at Carta is just thinking about the different people that we serve, right? So to your point, we serve almost 9,000 funds. We serve over 50,000 companies. We have over 100,000 LPs that log onto our platform, and so just being like fully immersed in this private market space and obviously indexed pretty heavily towards private equity and venture capital is honestly just an interesting space to operate in and meet founders and fund managers every day for a living. So that's great. In terms of the unique, I guess, perspective that it gives us, there's two sides to it. So I think one, which is obviously just the day to day meeting people in the space all the time. I think it gives us and certainly gives me a feel like I've got a pulse on the market. At least for me, it's in Singapore, it's in Abu Dhabi, it's in Sydney and Hong Kong. These are the four markets where I spend the most time. But globally, as a company, we've replicated that same model globally, and so as a company, I feel like we've got a pulse on private markets, anecdotally, subjectively, qualitatively. But we've also got this amazing data insights team that can actually take all of the data that we have on our platform again across those 50,000 companies and 9,000 funds and all of that and actually start to really analyze that and draw real insights and real trends, whether it be on the asset level in terms of what we're seeing of fundraising and valuations and equity compensation and things like that at the company or the asset level, whether it's fund performance benchmarking of how are funds actually performing, how does it differ by vintage, fund size, et cetera, et cetera. You can cut that by a lot of different dimensions. And then even more recently, we've been able to release things around fund economics. So not just the fund performance, but like the fund operations. How did those really work? Are there any changes we're seeing in terms of the economic structures, the GP commitments, the fee structures, et cetera, which is something that, LPs are really, curious to better understand. And then last but not least, as we've gotten into private equity, we've also got a point of view on private equity in terms of executive compensation, compensation for their portfolio companies, and things of that nature. So yeah, all the data, the quantitative stuff is also quite interesting. So yeah, happy to jump in to any of that, whatever feels like kind of most relevant.
Yeah, no, for sure. I guess curious, as you talked about, you guys started with cap tables, moved into, fund management and ops, and I think more recently also went into like LP related relationship stuff as well. So curious how you're thinking about like, product expansion across those different, I guess, within the same stack of venture capital, but then also adding in private equity. Are you thinking across like private capital markets? How do you guys think through some of that product decision making?
Yeah, it's been a really fun journey. I think really just kind of mapping the entire ecosystem out, and I mean, our CEO Henry talks about this too. I don't think we saw it all on day one. This wasn't like the master plan since the beginning. We kind of went step by step, effectively just focusing on solving a customer problem, right? Classic founder mentality. Like the original problem statement was like stock certificates are on paper. That seems weird, and they're very expensive to create, distribute, and they're kind of hard to track. You lose that stuff. I mean, it was a very simple problem back in 2012, but worth solving. And then step by step, every step of the way, we just kept running into new problems that needed solving. So when we started with the kind of the e-shares kind of cap table solution, well, actually, it's funny, even the e-shares bit of just being like PayPal for equity, as we used to call it, took us to cap tables because we're like, well, the cap table is just the ledger of who owns what. And since if we're going to digitize that, we could actually do the cap table. And that led us to valuations because it was like, hey, every company needs a valuation. They're paying service providers a lot for that. But now we have more data to do the kind of benchmarking and comps that are used in that valuation process as well as anyone else. And then we kept just solving those problems. And then when we solved so many company problems, we had all these basically VCs logging into the platform and seeing the shares they hold in tens, if not hundreds of startups. And then they came to us and say, hey, this is really interesting. You have my whole portfolio or a majority of my portfolio on the platform. It's really slick. I can log in and see it all in one place. When I bought it, how much I bought it for. You also know how much it's worth now with the valuation piece. Could you tell me my net asset value? Like, I think you'd be really close. Maybe you're missing a few details, but you could actually give me my net asset value. You could start calculating IRR for me, TVPI, DPI, and that's kind of how we stumbled into fund administration in a way. And so we said, yeah, that seems totally doable for us. In fact, we have a unique advantage to be able to do that because we have all the asset level data. So therefore, in theory, doing fund administration or fund accounting should be relatively straightforward from an accounting perspective. And then we just had to figure out the workflows in terms of how a fund actually conducts itself. How does it form? How does it subscribe people into the fund? How do you KYC those people? How do you call capital? How do you make investments? So on and so forth. But one step by step, and as you alluded to, that's kind of the same thing that's taken us to the LPs or the allocators now is with, as you noted, almost 9,000 funds that we administer, hundreds of thousands of LPs log on to our platform, everyone from high net worth individuals all the way up to sovereign wealth funds. And they are starting to have the same experience with us where they're like, hey, this is great. Like, I invest in 10 funds, seven of them are on Carta already, and I can kind of log in one place and see all of that in one. I have these other problems at my level. I have issues benchmarking fund managers against each other and against the market. And the data is pretty fragmented and self-reported. So there's not a lot of data fidelity there. Like I would love to know, how my fund managers are really doing. Similarly, I would love to understand my exposure at an asset level. Like there are investors probably holding Carta 5 different times at 3 different prices based on the funds that they've invested in, and all those funds having invested in Carta. We've done multiple fundraising rounds, for example. So those kinds of problems, in many ways just present themselves to us. And then, as usual, if we have a unique advantage in being able to solve that problem, generally stemming from some form of transformative connectivity that we have through the suite of products that we bring to market, then that's a problem that we're going to go solve. And so today, as you alluded to, we think of ourselves as kind of an ERP for private capital. If you think about it that way, we think that we're in the best position to connect these different nodes, assets, investors or funds, and allocators or LPs all on a single platform, as well as solve that problem across multiple asset classes, as you mentioned, venture, private equity, private credit, real estate, solve that problem globally across all countries and regions and major jurisdictions where companies form and investors want to obviously form and invest. And also, we want to do that across various, I'll call them functions or just workflows within the fund. So I think generally speaking, we've focused kind of on the back office. We do the fund accounting, the fund administration, tax, compliance, but we've really realized that there's a ton of opportunity in the middle and the front office as well. So the middle office, you think about portfolio monitoring and fund forecasting and valuations, and in a private credit context, covenant modeling and tracking. Like there's a lot in the middle office. Really, when you think about the investments team and the value creation teams, those are problems that we feel very well positioned to solve. And then even moving into the front office, right? When you think about the deal teams and you think about the transactions that they conduct, or kind of the relationships they have with LPs if you're on the IR side, or with prospective portfolio companies if you're obviously in the sourcing and investment side. So thinking of kind of a CRM capability there that we can really connect the social network to the pre-existing financial network that we already understand very well. So we understand those relationships. Can we bring those social relationships onto the platform and really start to marry everything together? So our product strategy in many ways is driven by this concept of connectivity, whether that be across nodes, across workflows and functions, or asset classes or geographies.
Exciting, exciting. I think like the expansion within the firm is really interesting. So, is that something you guys are looking into right now, or what's the plan? What's the thinking there?
Yeah, that's right. Yeah, it's a publicly kind of stated, product strategy. So yeah, we want to be the one-stop shop, for lack of a better term, that a fund manager needs to come to if they want to run a fund, if they want to form a fund, run a fund. Carta should be the only software you need to buy, and will bring to bear all the different capabilities, feature sets that you need in a relatively modular way as well. And I think that's what's really exciting is like we're kind of doing this concurrently with this AI revolution. And Henry is, our acting CTO right now. So he is deep in it with the engineers in terms of obviously fully embracing AI, not just to speed up, how we actually write code and deploy code, write, test, deploy code, but also thinking through the first and most impactful, I think, capabilities that we can bring to bear for our customers, right? So it's an interesting business we're in. We have to be 100% right. It's a very deterministic context that we're operating in, but there's a huge opportunity for AI to transform this industry from something that used to be very like reactive, almost ticket based structure that you have with like a fund admin or a service provider. It's like I need something, I ticket, I email, and then I get something, to something that's far more proactive, kind of always on, kind of orchestrating in the background and actually being a lot more intelligent. And so that's really exciting as well, is just like embedding those capabilities in, and then like I said, just having the different modules that you need.
For sure. And you mentioned you're across a bunch of different geographies. Um,
Yeah.
how are they different to each other? Like in terms of your customers, I know they're all like, if it's venture managers or even startups, how do you see much difference across these geographies? If so, like what is it?
Yeah, I have a very interesting region of coverage,
Yeah.
or just a geographic remit, which is, like I mentioned, Asia Pacific, which has its own sub regions within it that are extremely different, like ASEAN versus Hong Kong, Greater China versus Japan, Korea versus Australia, New Zealand, just to give a couple examples. And then there's obviously India as well. Then there's Middle East, which is, predominantly a lot of our business is coming in UAE and Saudi, um, but yeah, really across the Middle East, the GCC, and then more recently Africa as well, which is very new for us, but very different. And to answer your question, I guess shortly, yes, there are tons of differences, which makes the job really interesting, but also difficult, right? Is how do you think about deploying our resources and investments in a smart and thoughtful way to maximize the value that we can create across such a big surface area geographically? Um, right now, our core bets are really around Singapore, Hong Kong, Australia, and the Middle East, where we've set up in Abu Dhabi. So those are kind of the four focus regions for us. And if I just I guess, draw like a high level comparison. So, Hong Kong is still actually the biggest market if you just look at total addressable market on the private equity and venture capital side, just in terms of however you want to measure it, assets under management, number of fund managers, asset level activity, if you think about Greater China as well. So it's still the biggest market. Obviously, it went through a bit of a kind of a pretty cold period, frankly,
Yeah.
over the last 5 years. But we think it's bouncing back. We've made a bet to expand to Hong Kong, so kind of a contrarian bet, I guess. But we see it bouncing back in a big way, and it has such a long and rich history, such a depth of financial services experience and talent. And now, geopolitics continue to change as well, where you're just seeing a more diversified approach, right? Like everyone, you can't really be all in on anything anymore. And so Hong Kong is really interesting in that sense. I think because of the gap over the last 5 years, there's not been a lot of people investing in Hong Kong. Certainly not a lot of international companies, service providers, capabilities that have been coming into Hong Kong. So we're probably one of the first to make a big move, at least in our space, into Hong Kong, and so we're pretty excited about that. But that's kind of a legacy market that we think that we're going to end up disrupting, shaking up, and transforming, hopefully a lot quicker than some of the other markets because we've learned a lot. Versus maybe a contrast, the Middle East is the smallest market if you look at the total addressable market, but it's the fastest growing market year over year. Again, across any of those measures in terms of new fund formation, assets under management, so on and so forth. And that's we made a bet there too, but that bet was not a contrarian bet. It was just a bold bet in that how early we bet on it. So I think we made the decision that we wanted to participate in the Middle East private markets 3 years ago. It took us some time to get set up and get licensed, but we've been there and we've been working with some of the largest venture capital firms there for years. And so in that market, we're kind of an incumbent in a sense. Like I think we're reasonably well known at this point. We've spent an incredible amount of time there. We've got a team on the ground. And so we're kind of growing with the market there, where we're very much there. We're trying to make it happen and equally, obviously support a disproportionate share of all of the companies and fund managers in that space and kind of make it happen with them. And then you've got the kind of Singapore and Australia, which is somewhere in between for both sons. One, Singapore is just a much more kind of, I'd say, conservative, traditional, and a bit more, process oriented. They're very comfortable with service providers and a certain way, a business model of doing things. Versus Australia, you've got a more, I would say, technologically progressive community that can really do thorough due diligence on any technology provider, including Carta, which is great for us because we genuinely believe in the strength of our tech. But you know, we'll engage those customers for a very very long time to make sure that they're really really comfortable with our capability set. But once they make that choice, they really understand what we're talking about, and they have a strong desire to actually run a lot of their finance and operations in house, which I think is great. And so that is very different from all the other markets. Like in Middle East, Singapore, Hong Kong, most people are still outsourcing most of their back office and parts of their middle office, but Australia takes a tremendous amount of ownership across the stack internally themselves. And so again, there we think we can be a software player. So yeah, the markets are super different for us as well. And then in terms of where they're investing, they all have certain strategic or kind of natural proclivities based on the natural resources available in that country, the strategic priorities of the government, the kind of I guess history and background of depth of talent that they have, the industries that have historically been successful there. So that's kind of a nice even spread. You've got a little bit of everything across the big region, and everybody's kind of complementing each other. So we're seeing the cross border open up a lot, which is great.
Yep, yep. No, very interesting. And how when you go into these type of markets, I imagine like there are incumbents that they might be using some sort of software, and that software I imagine has decent spread across the particular region. How have you found kind of coming in and displacing that type of software that's already kind of embedded into, the local kind of venture scene? Um, or and like what's been, I guess, the hardest challenge when doing something like that?
Yeah, it's it's really interesting for us that we have competition across almost everything that we do, but we don't have any competition that does everything we do, if that makes sense.
Yeah,
So in any of our discrete use cases, whether okay, there are other cap table players, mostly anytime we show up to a country, there's at least one local version of Carta on the cap table and equity management side. Most of the time they are inspired by Carta as well. Like we meet the founders or we meet the team and we're like, they're like, yeah, you guys were doing it in the US. We thought it made perfect sense. So, we did it here. And it's honestly great because frankly, they've shouldered a lot of the hard part of awareness and education and just this idea that you would move from spreadsheets into software at the basic level. So they kind of did that hard part, and then we're coming in and saying, "Well, that's fantastic." And look, we ideally the ecosystem grows as a result of both of us being here, right? And people will make their choice on the software side, but if we can grow the whole innovation ecosystem, then there's more than enough room for two players in every market. I always use like the Uber Grab or the Lyft Uber example. Like
yeah,
I feel like cap tables is a market where you can have at most two players. Like there's just not enough for three. And you can have one, but two is good. Two is good for competition. You want
yeah,
customers to have choices as well. So I think that's kind of like our competitive landscape, broadly speaking, on the cap table side. And cap tables is a tough business if you don't have additional service offerings or additional things to do. It's a high velocity, low deal size business. It's critically important when you need it, but it's not something you log in every day, right? So, and especially in this era of AI where you can build apps pretty quickly, like cap table is certainly one of those areas where you don't want that to be the only thing you have. Like it's important, but I think having a product portfolio and also the network effects of a platform make a lot of sense in that context.
yeah,
On the fund admin side and the fund kind of broadly, I'll just call it like the fund financial side, traditional service players, right? They're more global in nature. So the cap table players will normally be very local, maybe regional, but the fund admin players are all global, right? Usual
yeah,
suspects, tens of thousands of people globally, proper professional services companies at the core of them. And so there the real, decision point for anyone is like, hey, do I like software or do I like services? What do I believe in? Right. And if they believe in software, they're probably going to end up going with us. And if they believe in services, they might still go with us because we offer services as well, and certainly having technology enable a large portion of kind of the preparer and the reviewer activity that happens just makes our service team kind of, I'd say, kind of more elite, almost like a SWAT team that just handles the real complexity, the exceptions, and kind of focuses on kind of customer management.
yeah,
Or they may choose a traditional service player because they've known them for 10, 15, 20 years. They're comfortable, nothing's broken, and that's okay too. I mean, technology adoption curves are long. We understand that, and our goal is not to, force anyone into doing anything that they're uncomfortable with. There's plenty, as I mentioned, in just like the total market. But I do think that that rate of adoption is going to accelerate, if not naturally, a little bit just in terms of the overall market pressures that we're seeing from LPs and from the entire world,
yeah.
in terms of like AI and other things. So yeah, it looks a little different. And then if you break down to any of our subcomponents like fund modeling, CRM, valuations, like each of those will have its own kind of niche point solutions for sure. But then it's like you're operating a private equity fund or a venture fund is not like a company, right? It's yeah, they may be managing $1 billion, but they still probably only have 15 people, maybe 20 people, right? It's not if a company has a billion in turnover, even today in AI, they will have more than 15 people, right? And so uh, I think there's a decision point there of like, do I really want to buy 15 different pieces of software to run this business that has 15 people? Or do I really want to invest any of these 15 people's time in building this? Or should I just take a software provider that all they do is think about this day in and day out, constantly building, constantly appreciating asset because they're investing hundreds of millions of dollars in R&D every year just to solve this one problem, and just kind of have them do it and focus on, sourcing capital, forming capital, and deploying that capital into amazing assets. So we're betting that it's the latter.
Yeah.
We'll see. Hopefully, if we're right.
No, I think those are some great points, and I think to the point that you just made, like I feel like obviously with a bunch of these AI coding tools, people are spinning up their own things, their internal products that help out their own workflow. Um, it makes sense that obviously that takes up a bunch of their time, but are you seeing that actually having any sort of impact on the business, at least when it comes to like the holistic business where it's modular, right? So certain parts of it, if someone's building it in-house, it might have an impact on your business. Is that a concern right now, or again, not really?
Um, we're seeing it for sure. It's not really a concern, and the reason for that is, frankly, I know this sounds a bit just like presumptuous, but like I think the more people that do that will realize how difficult it is to do it at scale for operational excellence every day, right? Because even if you vibe code an app today, which you can, and I've tried it, it's fun, but it's outdated in like 3 months today. And if that's not your primary job, are you going to go back and, like, keep recoding it,
Yeah.
and keep iterating on it and making it better? Or are you gonna, like, solve the problem, go back to investing, and then realize what you have is now outdated and not, being maintained well? Or do you wanna have, work with somebody who all their only job is to take everything that OpenAI, Anthropic, uh, Google, DeepMind, anybody else is coming up with, taking that, contextualizing it on proprietary data sets that are very industry specific across 50,000 companies, 9,000 funds, hundreds of thousands of LPs, with millions of documents, records, transactions that we've seen specifically in this space, then training on those models almost like an SLM on that particular data set, and then thinking through how to then embed those capabilities, agentic or other or generative or otherwise, into the platform that they anyways use to conduct their business, and then bringing those to bear, generally speaking, for free.
Yeah.
Most of the advancement that we release in our products, most of it as a percentage is just comes into your subscription, right? It's just like, hey, we have a new feature, please use it, right? There are a few things once in a while where it's like, hey, you're gonna have to pay more for this big release, but I'd say like 80% of our releases just hit you, for free. So you have this appreciating asset relative to the subscription model that you pay. And we're not like a seats based, SaaS either. I know that that's being challenged a lot right now,
Yeah.
but ours, we never relied on seats because our customers are small. As I mentioned, a private equity fund could be managing a ton of money. They don't have a ton of people. So we're not like a seats-based model. It's much more value-based, frankly. It's like the amount of capital that you manage and that we then help you track, account for, report, analyze, transact, et cetera. Like that's the relationship with Carta.
Yep. Yep. No, those are fair points. In your, you guys do some great work with putting out these massive reports across the sector. As you mentioned, you have a great data team. Um, when it comes to the, I guess, Australia, New Zealand region, have you noticed any interesting insights when it comes to, fundraising on the venture fund side, um, over the time that you've been operating here?
Yeah, it's the Australia. So I'll tell you this. So On the Australia side, we haven't published any data Australia specific, frankly, just because we don't have the sample size yet that we would feel comfortable publishing. Like we support GPs in the region, we support plenty of startups in the region, but then when you start cutting it by different dimensions, like you want to cut the GPs by vintage year, by size of fund, now you start to get to intersections where you only have one or two, and it's like I don't think I can publish that as a trend yet.
Sure.
So I think most of our observations are pretty anecdotal or just kind of from being on the ground and speaking to folks. But from that, I will share with you that I think what's really exciting specifically around Australia is it's actually been had um, a relatively early start and it's had more success. It's punched way above its weight in terms of success, in terms of exits and the ability to export technology globally, which I think gives LPs and therefore fund managers and therefore founders all much more incentive to continue to participate in that entire cycle
Yep.
versus a Singapore and a Southeast Asia, which has unfortunately the opposite problem, right? Where there just haven't been globally exported technology brands coming out that have created huge exits, returns, and liquidity that then get recycled back into the ecosystem. And also, then you get those that the talent and the teams from those that then recycle back into the ecosystem as well, whether they go start another thing or they become an investor or an advisor or somehow participating in that. But you've seen that in Australia, which is really exciting. And then particularly, you've seen this tilt towards more kind of what I'd call like deep tech, biotech, where partially because of obviously some of the R&D grants and provisions that are made available in terms of the policy perspective, which are further supplemented by additional policies like tax concessions related to early stage investing and employee share schemes, all of which looks and feels a lot like the US, frankly. Like if you just think about the tax regime and then where all the concessions and kind of grants and exceptions come from, there's similarities there that make Australia feel very exciting. And like I said, punching above its weight, frankly, in terms of just the overall market opportunity, but the outsized impact that it's having. And hopefully, this year we'll see something with Canva and maybe a few others that will be kind of just like the next wave of that
Yeah.
in Australia. So that's really really exciting. You also see this interesting trend where I think people have really earned their stripes by the time that they start managing meaningful capital. If you look at like some of the biggest firms in Australia, whether it's Airtree or Blackbird or SquarePeg, et cetera, like they all actually have really earned their stripes, starting with very humble beginnings and humble roots. Maybe it even started as a syndicate, a deal by deal kind of thing, and then really work their way up into becoming legitimate billion-dollar venture, fund managers that are still deploying a majority of their capital into Australia. So very like domestic, regional focus. I think that's incredible. We have fewer people operating at that scale with that regional domestic focus. The Middle East now is starting to have that because of some of the strings attached to sovereign money, and there's a lot of that. And so that's kind of it's a forcing function to accelerate, but I would think that they've picked that up from markets like Australia where it's worked really well. And in the early days, Singapore did that, but it's gotten away from that a bit. Hong Kong
Yeah.
now is also doing that strategically as part of like the kind of the restart or the recharge of that ecosystem as well. You're seeing HKIC, for example, start to like seed fund managers in exchange for setting up in Hong Kong, investing in Hong Kong, et cetera. So yeah, I think Australia's just been ahead on that, but they didn't have to, it didn't have to happen necessarily top down. It kind of happened organically, which is really beautiful.
Yeah. No, great insight. Um, I'm curious on your opinion on, I'm sure you recently heard the A16Z raised like 15 billion, which was a large portion of like total venture funding raised by venture managers. You
Yeah,
guys obviously on the fund admin and financial side service fund managers. If we start seeing like these large, brands able to raise majority of the capital, and there's I guess a reduction in the number of funds in the space,
yeah.
how do you think through that? Is that something you think about when it comes to the market, or yeah, how do you think through that?
Yeah, we certainly think about it. It's interesting. So I think there's like we have a perspective on it. I think from a business perspective, we're reasonably resilient in either scenario, because as ultimately, as long as the total capital that's being raised and deployed into private markets remains consistent or hopefully grows, then that's kind of defines the market opportunity for us. I mean, to give you the simple example, we go from a company that has like an SMB, a mid-market, and enterprise motion, and all of a sudden we just have an enterprise motion because there's only big funds raising tons of money. So
Sure.
we're resilient. We'd have to change what we do, but I don't. I think from an intellectual perspective, we certainly have a perspective, which is we've seen time and time again in our data that emerging fund managers, excuse me, emerging fund managers outperform on the top decile versus established or upmarket fund managers, which makes sense, obviously, because you think about the returns that an A16C has to generate on 15 billion. Like,
Yeah.
you know how many unicorns, like when you do the fund construction model, you know how many unicorns or decacorns have to come out of that fund to give you a above market return there, versus like the economics of obviously the management fee and et cetera. Like they can make more money with a lower return profile versus obviously what an emerging manager can do. So, which is the incentive to obviously raise bigger funds. And these days, thankfully for them, probably they now have an asset class in terms of AI infrastructure that they can pour that much money into because it's really like capex
Yeah.
nowadays. And in some of these companies that is happening through venture, which is really interesting. That used to be more of like a debt situation. So I think thankfully there's a story about why you would want to raise that much capital and how you're going to deploy that much capital, which didn't exist, frankly, 5 years ago in the SaaS era. Like nobody needed that much money. It was kind of concerning if you did. But time and time again, emerging fund managers outperform, like I said, on the top decile. And the reason for that, the underlying reason for that is by definition, if you're an emerging fund manager, you have to have a much more discrete and nuanced thesis in theory, and it's got to be something that they feel like they know better than everyone else. They have a unique edge in terms of being able to source, invest, and value create for those deals, and they're probably doing it in a pretty discrete part of the world as well. Like there are a lot of characteristics that tend to correlate with an emerging fund manager, and that is critical for jumpstarting new industries or new capabilities, right? And so I can, and then if you think about venture as an asset class, so you zoom out and you think of the LP perspective, right, in terms of their allocation first to private versus public, and then within private, how much is going to venture versus like growth, like early stage venture versus growth versus private equity buyout versus private credit debt yield type instruments and real estate. Like there's a diversification there too. So when they look at the venture asset class, by definition, that's the piece that you're looking for the most alpha
Yeah.
just as a result of that asset class, and you're balancing it out with the rest. If you start looking for beta in the venture asset class, which is basically what you're doing if you're investing into the Andreessen like large fund at that point, then where is the alpha coming from? I think is a question just from a portfolio thesis perspective. Whereas if you look at an emerging fund manager, yes, it's true. Many of them just don't return, but that's venture. That's always been venture,
Yeah.
and you're playing for the alpha. You're paying for the top decile who have outperformed, and those have been emerging fund managers time and time again. Because for them, they just have to hit on one. There's a power law still applies, even if it doesn't apply to the extent that it does in the U.S. Because people talk about how Asia and the U.S. are different in terms of the ultimate upside on an asset. Like in the U.S., you have a listing, the path to liquidity is more clear. In Asia especially, you see much more M&A from strategics. You see people even selling off on subsequent rounds just to get some DPI and hopefully fight for a second or third fund.
Yeah.
Like there are different dynamics in Asia, and then obviously the IPO markets are very different across Australia, Singapore, Hong Kong, and Middle East as well. But put all that aside, if you're an early stage investor, you're probably doing 10, maybe a 10 to 20 million fund. The construction looks very similar. You're maximizing shots on goal,
Yeah.
and you got to get one or two of those right, substantially right. And that has That has always been true, and I think that there's always a space for that, and there needs to be a space for that because that's what feeds the Andreessen, right?
Yeah,
Those
of
1 or
course.
2 are gonna be going into the growth funds, right? And, like, somebody's gotta get that started, so there's a cold start problem there as well.
Yeah, no, great insight. Final question I have is there anything that you can talk to us about around like the current corporate development M&A kind of thinking or strategy that Carta might be having right now?
Yeah, I've been obviously somewhat limited in what I can share on that topic, but I think what I can share, which is reasonably public, but maybe not known to everyone, is we've been acquisitive over the last 3 years now. We did two acquisitions in 2025. We did one in 2024. We had done like 10 before that as well. So
Right.
we've always been a pretty active company in terms of corp dev. But I think you know, I think the more recent ones have been much more discreet in terms of adding a capability set very clearly to what we have, whether it was Tactic in 2024, which gave us really the fund construction, fund modeling, almost the FP&A for funds capability in terms of multidimensional modeling, analytics, really forward looking versus backwards looking. Then you look at Acelex, which we did in 2025, which was the first product that took us directly to monetizing the LP or the allocator, and really our first like AI native product in the sense that effectively what we're doing is automating the extraction, classification, aggregation, and then analytics on fund of funds, sovereign wealth funds, LPs, right? We're able to now combine the direct investments with the fund investments and basically try to automate the entire process of understanding that exposure and analyzing it end to end,
Yeah.
which is really powerful. So that took us into a whole new node, a whole separate product, and then those capabilities will actually then extend back across the Carta stack. When you think about just document extraction, classification, aggregation, et cetera, which is very bespoke in a fund context and fund semantics, which is why we thought that made sense to invest in, and a great team as well. And then the third one more recently was Servatus, which if you think about what we've always done, we've always connected the asset to the fund and then the fund to the allocator. That's our unique advantage that everything is connected. And we realize that with this surge in private credit, all of a sudden there's a lot more demand for this asset class, but the asset is not a company. It's not going to be solved with a cap table like private equity or venture capital. The asset is a loan.
Yeah.
And so what we needed was a again AI native, sophisticated loan operations and management capability that could then take us to covenant modeling and covenant tracking, which would then give us enable the rest of our suite to work as is, whether it's fund accounting, fund admin, tax, compliance, valuation, all that kind of broadly looks the same. But these asset level pieces we needed to bring in, and again, rather than building it ourselves, there was just a fantastic team that was working on just that piece.
Yeah.
And so it's a marriage, made in heaven, so to speak, because they've got the experience, the technology. AI has totally accelerated our rate of integration when we think about a new code base into our existing code base. So technology integration has become way easier because
Yeah.
if you know what you're aiming for, Claude Code can help you build it really quickly. And so you can kind of do that really quickly, and then you immediately get our distribution, right? So
Yeah.
we've already spoken to probably all the folks that need this, and so that I think gives a pretty good insight into our corp dev strategy right now. And as we look forward, we'll continue to look at opportunities because, as I stated at the beginning, like we have a pretty clear stated objective, which is we want to try to make private markets operate more like public markets in terms of the transparency, the consistency, the accessibility, the equity across that. And we think that happens through financial infrastructure. And so that's where the network DRP product comes in. And anywhere where that network DRP is currently falling short or has a gap in terms of servicing the capabilities that our customer needs, that is the natural corp dev,
Yeah.
target or strategy, right? It's always that thing of like, should we build something? Should we buy something? Like, how is that? Or should we partner? Right. And those, we look at all three of those vectors all the time.
Very great. Thank you so much for the insight there. And yeah, that's all the questions I have, Bhavik. Really appreciate your time, and I think it was super insightful learning from your experience in these markets.
Yeah, no, thank you for having me. Thank you for giving me the opportunity to talk a little bit more about Carta and what we do, which is not something we do as often. But we love talking about the industry. We love talking about the markets and the trends. But it's fun to also reflect on our role in all of that. So thanks for giving me the opportunity.
Of course, and thank you so much for your time.